Good morning, ladies and gentlemen. Well, by my calculations, manually, we are somewhere in the middle, i.e. showing absolutely nothing on the risk dial. We have a very interesting couple of weeks coming up, what with QT, the ECB and the Fed. So let's try and see if we can get any clues from what the yield curve is saying, where the bonds are trading, and how that might translate into other asset values. The futures yield curve is an absolute mess. In blue, you have the prices at the end of Friday, and in red from 1 week ago. As you can see, not really much change. We're still going up in yield, but I think we are about to pause, as we shall see when we have a look at the individual tenures. I don't think it's really worthwhile thinking about this little dip in fives here. It's not significant, but what I think is significant is that we have priced in basically what the Fed is saying, the higher for longer. Twos are trading in nearly 18, 17, 18 basis points in yield higher than the previous week. And that is about as much as we can hope for at the moment. And we'll have a look at the Eurodollars as well. To me, the yield curve is now done everything that it has to do before the Fed comes in and before the ECB come in and tell us what they want us to do next. So I'm very, very neutral on prices now. I've taken most of the profit on the way up, and I'm now, very, very slightly short of futures overall via options, and I don't intend to add to those shorts for quite some time unless the central banks give me a decent reason to do that. Let's have a look at the euro dollars and what is anchoring the curve and what is going to actually lower volatility in bonds for the next bonds and notes for the next week or so. I think ECB 22 holds the key for the next few sessions simply because it's anchored. It's anchoring the curve, and as you can see, the movements of the other months are much smaller than they used to be. So we went up 6.25 basis points, down in yield 6.25 basis points in ECB 22, and we only went double that in the others. So while ECB 22 is anchoring and going up towards 96.75, these can't really fall very much, and therefore the twos can't go up very much in yield, and the fives can't go up very much in yield from these levels. So I think it's going to be anchored. If we have a look at where basically we have been trading in a 0 point range for the past 7 weeks in ECB 22, and the way the curve is priced, we are likely to naturally drift higher towards 96.75 in the next week or so, simply because that's the way the forwards work. If that happens, I really can't see that much more pressure on the twos and fives. And if we get some bad news, it'll be reflected on the 10s and 30s. But I can't even see that happening because the QT is a natural flattener. And therefore, I think that bond yields have done as much as they're going to do on the upside for the next week or so. Certainly before the Fed comes in. The ECB might give us a little bit of a jolt one way or another, but I don't think it lasts simply because the Fed is going to be that much more important. I don't think this is the time to have on flatteners. Certainly not for the next couple of weeks. As I showed you, the Eurodollars have discounted a hell of a lot, and they need to naturally drift higher. And if that is the case, the pressure on the twos is going to alleviate, and it's much more likely that we do one more high in the twos tens and we trade to around these levels, which is around the minus 18. So that's another 12 basis points of steepening. I really can't see what the pressure is on the twos tens, why they should go more negative for the next few days. Simply because we have discounted a hell of a lot, and it's much more natural for the yield curve to actually give up some than to re-steepen. Every single spread on the yield curve saw profit taking on Friday, and I think that that is correct. This is the 5s, 10s. I think we will wait for the Fed somewhere around par, somewhere around zero. I just don't see the reason to go now. In 5s, 30s, I think it's much more natural for us to re-steepen to around minus 20 and wait for the Fed around there. And in basically the 10s, 30s have reached my objective. I went long here, reached the objective, I'm out. I think it's much more natural for the whole curve to give up and wait for the Fed somewhere around these levels, around minus 20. That makes a lot more sense. It's only 10 basis points, but it will have worked off all its overbought. So for the next 5 to 10 days, I think it's more natural for the curve to steepen slightly. Despite QT being a flattener, that's what's not going to make it go too far. But people really need to take the profits on their positions and come back to neutral and then await the Fed. In the individual tenures, I think this trend is pretty much exhausted. How much further can we go without the impulse of data? And even if the data comes out, the natural tendency for the market is always to mean revert for the Fed. I just can't see CPI being such a big deal. We know what oil prices have done, what energy prices have done in the US over the past month, and that is not go up. In which case, I really can't see how we are justified in expecting an acceleration of CPI numbers. It just doesn't make sense. And the odds of it happening are very low as a result. So I felt a bit foolish taking profits when it went straight through me, but now I feel a lot better for it. If we actually have a look at, we've been going up for 1, 2, 3, 4, 5 weeks, it's much more natural that we come back towards this 308 to 299 area in the 5s. And if I have a look at an hourly chart of the 5s, I would have thought that this kind of area between 306 and 313 is almost certain to trade over the next 2, 3, 4 days. And then if we get down to this kind of area, which is 299, it would be a wonderful risk reward, short in futures, long in yields. Much more likely to go again from that level than not. The 10s touched my 324 level, backed off. I would have thought something like this is much more likely than we go straight through. As I said before, markets tend to mean revert ahead of a big event like the Fed, like the ECB. I would have thought we wait for the Fed somewhere around this 298 to 303 box. Only one more weekly bar until the Fed, and this kind of behavior around 303, 298 to me is much more natural than going now. Why would we go now? Where's the CPI impulse? I don't see it. Same thing for the 30s. I would have thought around 320 is the natural level that we go to. it's just unlikely to keep going. There's very little impulse that I can see for it to happen. Of course, Europe should be much more interesting than the US next week, what with the ECB and the message they're going to give out. I just find it very hard to believe that they're going to be very bearish simply because they are such a bunch of duds. So what could happen to their yield curve? Well, it's been flattening, that's for sure. This is the differential between 10s in US and the 10s in Germany. I am very bearish for this longer term. If I show you a monthly chart instead, you will see that every time we get to this mid 190s, it comes straight back off. I think this is a very, very good risk-reward area to be short of bunds and long of the US. But you can see how important a close below this 154, 153, 154 level would be on a monthly basis. We would take out what best part of a year and a half's range to the downside, and then I have no doubt that we'll trade all the way down to 100. That is what I'm looking at, and that is what I'm trying to figure out fundamentally why would happen. Well, the why would happen is obvious because the ECB finally realizes that inflation is a worldwide phenomenon and they need to fight it. So let's see what the ECB says. But to me, if we go up, I'm a seller, and if we go down, I'm a seller. So either way, I want to be short of European futures against long of US futures. And we will see what the impulse is. I can't tell now, but that is my primary, what I want to do at some stage. Whether I sell 140s or whether I sell 190s, well, the market will decide. The Schatz basically tested the previous highs in yield and backed off, which is natural ahead of the ECB. I would not be surprised for it to come down. To around 85 basis points or something like that over the first couple of days. We've gone probably too far too quick, but to me the impulse is still to the upside. You can see on a monthly chart that we closed at the highest level that we on a monthly basis, but also that once we recapture these levels, we tend to go higher. And I really think that we will go towards this 190 level at some stage. The question is, do we do it now or do we do it later? That is why I'm much more bearish for European yields than I am for US yields. I think the ECB needs to catch up. Inflation is a worldwide phenomenon. It's not a national basis. If we change to the bubble, you will see how the bubble didn't quite make it to the previous highs, and you'll see from the 10s, and I can show you the Bund, you can see that too. So the yield curve is flattening in Germany, and it should continue to flatten. So to me, the danger is still going to be in the Schatz, that the Schatz goes up towards the 160 level, and the Bund does not really exceed very much these highs. If I put this into a monthly chart and go back in time, you will see how the Bund is very much trading where it was for the and where it has natural resistance, around 209. That is going to be where the real resistance is, while the Schatz has got another 90 basis points to go. So I think the flattening tendency on the curve is going to be much more prevalent in Germany than it should be in the US for the time being. And if we look at the French market, which trades best technically, and we change that to a weekly chart, you can see that that didn't test the previous highs either, closed on a weekly doji, much more likely to await the ECB at these levels around 193 than it is at 213. And if we change that to a monthly level, you will see how we are very, very close to very, very good resistance. So again, the same message from the French market. The longer end is less likely to go up in yield than the short end. To me, being bearish of the short end from some natural resistance level is much more likely to be profitable than the long end. The dollar is really sucking all the oxygen out of the room for risk assets. And really all I can say is what it's not trading with, and that it's not trading with interest rate differentials. Whatever the Bund does and whatever the 10-year note does, it's not trading with them. And that is very important to realize. There are other factors at work here, and I think it's just sheer weight of money going into the safety of US assets or need for US currency to pay for commodities or whatever it might be. Given that fact and that interest rate differentials are just not driving it at the moment, it's natural to expect it to stop only when it reaches some major targets. And the major targets from previous dollar bull runs are these: 111.31 and then eventually 118 to 120. Very, very difficult to imagine that we are going to stop anytime soon in the US dollar. We can go all the way back to see what happened at the Plaza Accord, and you can see how, you know, these spikes just continue, and really I can't see any reason not to see it go to at least 111.31 and most probably 118 to 120, and then we can see some sort of intervention, another accord like the Plaza, that kind of thing, to try and make the dollar trend stop. And Europe really needs to make that dollar trend stop, because now it's in a vicious circle whereby the any kind of ECB hawkishness, and not that they're hawkish, right, is actually being completely countermanded by the weakness of the euro. And therefore, every time they hike, and the euro just continues weakening and makes it all for naught. So monetary conditions don't really tighten in Europe even when they hike. To me, that is what's probably driving the euro. And really, I can't see any reason not to keep on selling rallies in Euro USD. If we go to Euro USD, really, it's, to me, technically, it's obvious. Unless and until you get a weekly close above 103.95, call it 104, or even 104.38, you are selling every single bounce. There is no fundamental reason to own it, because it's just not trading even on differentials, on interest rate differentials. Any interest rate differential in favor of the euro just gives it a little bit of a push, and then it's sold immediately. Tells you all you really need to know. Don't fall for that trick. Look to buy straddles when it gets to 104, because it really could go a long way down. If you look at that DXY 111 and then 118, within a few months, you're looking for the euro to fall into the high 80s. Well, gold is trading with yields, real yields, and it's trading with the dollar. I actually expect it to probably do slightly better early next week and retest the 1764 swing level. But after that, I think it probably at some stage falls down and closes a week below 1710, which to me will be very significant and will mean that we are going to retest the low 1600s at best. That would really fall in, the pieces of the puzzle would fall into place like this. Over the next few days, bonds do slightly better, and as I showed you earlier, that lifts gold. That makes the differentials between Europe and the States come in slightly. That makes the dollar basically tread water ahead of ECB and certainly ahead of Fed. And then you get a little bounce in gold, and that eventually gets sold. Whether it's 1764 or 1810, I have no idea, but I think that those levels again are going to be a very, very good. Basically at 1764 you do half, at 1810 you do another half of put spreads, looking for it to within a couple of months, i.e. year end, trade this this kind of level 1613, or this kind of level 1570, 1580. That to me seems to be more logical than not, and that would imply that bond yields have not made their absolute high. And that makes sense, because if the oil price doesn't stay low forever, and we'll look at that next, at some stage bond yields are going to reaccelerate, because that will mean that CPI reaccelerates. If we look at DBC, it's very telling that this 26.93 level just cannot be broken. Trades up there, boom, gets absolutely smashed. To me, that indicates that we are probably likely to test lower. And I would love to see this 22.91 level, which is a 0.382 retracement of the whole move up. That would be like an ABC, and that would give you the, would fall into place with everything that I've been saying. DBC comes down, gold comes down. This ratio between DBC and gold remains pretty much constant at this very important level, where I start preferring gold to DBC. That all falls into place, and then just as everyone is saying, oh my god, DBC is going down, bonds are going down in yield forever, you get another reacceleration higher and everyone is screwed. That would be my really, really preferred scenario. And why? Because you are having certain things happening here, which is copper, and this is the weekly chart of copper. We've had several weeks of going up, now we're going down. Would love to see it down here, break new lows on the move, get everyone bullish in bonds, and boom, return back up to around 417 from there. And this is, the chart of gold against copper. And you can see that it's really indicating that bonds are going to do slightly better over the course of the next couple of weeks. Certainly, it's not giving you any reason to think that bond yields are going to start spiking. And you know that a lot of people watch this very carefully. and I think it's certainly leading the bonds slightly better, or as I said earlier, it's just going to be mean reversion in bond yields. But either way, it's bond yields are probably likely to fall between 5 and 15 basis points over the course of the next few days. And to me, that is reason enough to not be too bearish of bonds, and therefore not to be bearish of other assets I will show you earlier. But if we have a look at now oil, to me this is a wonderful chart that says let's hit 75, let's stop everyone out, and then do something like here, boom, back up to 110. So I am short-term bearish DBC, short-term slightly bullish gold, but bearish longer term, and then I am short-term bullish bond futures rather than bond yields. I think that bond futures are going to rally a couple of points here in the very short term, and then we see what the Fed decides. I think Friday was just stupidity. And why? Okay, this to me is the canary in the coal mine for Friday, the thing that didn't happen. XLY, SPY XLY did not break up. In fact, it went slightly down. And this is the other canary in the coal mine. The equal weight consumer discretionary and staples did not make any kind of a move. The risk part of the index did nothing, and to me that says that whatever that sell-off was just that, sort of thin Friday ahead of a bank holiday. A headline comes out, everyone gets caught offside. The headline actually means nothing, because it was well known that the Russians were not going to reopen this pipeline on time. So to me, that was just complete rubbish. If we have a look at SPY IEF, did basically nothing, and just sort of is at support mid-range. So it's really saying nothing. To me, Friday was rubbish, and having said that, let's have a look at what's likely to happen in asset prices next week. Fundamentally, I think that we have found our range, which is between times 16 and times 18, and that's all there is to be said about this. We are unlikely, really, unless SPY XLY starts breaking much higher. We are very, very unlikely to start getting earnings expectations going down significantly. I mean, if the consumer is 60% of the economy, the companies are not really going to start doing much worse unless the consumer gives up. So to me, for the foreseeable future, and I'm talking months here, it's going to be between times 16 and times 18. For anyone that's still doubting the relationship between equities and bonds, this is back to the 30-year on a daily, and let's have a look when the high came in. The high came in here, 616, okay, the 16th of January. Now let's have a look at the ES. When was the low? The low was on the 16th of June. Okay, so the lows correspond absolutely. What is going to happen, therefore, to equity yield, to equities? Exactly the same thing that happens to bond yields. I find it very, very difficult to believe that next week we bust through 38.55 unless bond yields start breaking up, and I really don't expect it. To me, the opposite is likely. To me, it's much more likely that we go back towards 39.83 and then settle in a range between 39.83 and 40.77 over the course of the next few days, waiting for the Fed. To me, that is a much more natural progression back towards these moving averages. I certainly am a buyer of call spreads heavy at 38.55. That will be very close to the times 16 Blue Angels that I showed you. And the risk reward from there, I think, will be overwhelmingly up towards 40.77. In NASDAQ, the levels are very clear. I am a buyer of call spreads in here between 11,850 and 11,566. You can see this 11,760 level is very important on a weekly close. I think it is much more likely to bounce off there and go back up towards 12,947 with bonds. So I'm a buyer of both. I can't see the S&Ps are just, I showed you the risk. I showed you XLY. If XLY does not break, I really can't see that the S&Ps are going to break either. They're trading with bonds almost 1-for-1, and to me it's much more likely that they go up next week than down. If the market is supposed to be under some kind of a stress, as some people are tweeting out, I can't see it in the VIX. It's just not being shown. Every time it gets to 27, it gets sold. And even that complete fiasco on Friday, what did it do? It just took VIX back to where it opened. I mean, it's just pathetic. To me, it's much more likely that we get, we come back towards 24 and stay there for the foreseeable future ahead of Fed than it is that we start breaking the 30s. I would get very worried if we start breaking the 30s. And probably think that in which case we could do that with a combination that we tag 38.55 again. But let's have a look on a weekly where that level is. We're looking, 38.61 and then down to 37.11. I think that is much less likely than we wait for the Fed somewhere very close to this moving average here, in just above 4,000, 4,050. To me, that is much more likely. But, as I said, if the VIX starts breaking 30, I'll change my mind with it, with the facts. I just can't see. The bond yields will have to start breaking quite a bit higher for that to happen, and I see absolutely no reason for it to happen now. In Nikkei, the risk-reward point is very, very clear. 26,910 on the dailies, 26,940 on the weeklies. What's 30 ticks in that? Nothing. So, call spreads at those levels, it's very, very, very clear to me. And if we have a look at what the European markets are doing, they're saying the same thing. Weekly, 33.83 is the big level to me. If it gets down there, it's a big buy of options, and really it should not close below 34.68. The fact that Europe went down least on Friday, in fact it didn't go down at all, tells me that the whole fiasco in S&Ps was just a technical affair. If we look at the DAX monthly, we are right down on support on the monthlies. I can enlarge that. very, very rarely does it close below the monthly support and the monthly Bollinger Band. And to me, therefore, the likelihood is that we get news that squeezes it back up to these levels, which is what, 13,350, that kind of thing, 13,300, much more likely than we get a complete breakdown in the DAX. So to summarize, I think the yield curve next week, if anything, it's going to go counter trend, i.e. the short end is going to be stronger in price and lower in yield, simply because I can't see EDU 22 and the front spreads on the Eurodollars doing anything but going up in price, down in yield. And given that fact, I think that 2s and 5s are unlikely to lead, and I don't think that 30s can lead, simply because inflation is likely to be lower rather than higher, and therefore all the action really is going to be in the European yields. And I really am very bearish of this spread, and I'm looking for fundamental reasons and technical reasons to own the States over Europe. I will see if that is because the ECB tells me something on Thursday, or because the market just starts anticipating it, but that is the position I want to end up with. As far as everything else is concerned, I can't see that equities told me anything new on Friday, and I can't see that they are going to go through that times 16 Blue Angel. See absolutely no reason, and therefore these are the levels. I've changed them all, and I think at those levels the risk reward is to do call spreads. DXY is going to keep on sucking the oxygen out of the room, and therefore the upside for all these is going to be limited to those to the resistances, and that's all that can be said. Gold, I'm definitely going to do some put spread at 1764, and an 1810 I will add to them, because I think at some stage bond yields again go up again, and that will be a killer for gold. Thank you very much indeed. Have a wonderful Labor Day holiday tomorrow, and I'll tweet you on Tuesday.